Thank you for coming on this summer Friday. Hope you're looking forward to the weekend with the 92-degree temperatures. This is the fifth installment. Okay, better. There we go. This is the fifth installment in Tax Foundation University this summer, and the last one, we're going to go over some fundamental concepts in tax reform to help you try and sort through the basic ideas behind various types of tax systems. Now we've got maybe 3 key points for the lecture today. Here we go. There are 2 basic competing ideas of what to tax, what the tax base should be. You could call one of them income, but we have to define that. And we could call the other one consumption, although that's not quite what's going on. But basically income versus consumption, and the definitions are important. The second key point, there are 2 areas where you have to be particularly careful in designing a tax system, and one is how you treat cost recovery, that is to say depreciation, and how you tax interest, what you do with it. And they differ according to whichever type of tax you're looking for. In some ways in one type, another way in a different type. The other point, and we made this last time, is that an income tax falls harder on saving and investment than it does on consumption. And there are many types of tax systems that are more neutral in treating saving and investment on the one hand versus consumption on the other. And the more neutral taxes will support a higher wage and a higher level of employment and a higher level of GDP for the same revenue raised. So that's a key point to keep in mind. Last time we looked at some of these differences in the tax treatment of saving and investment. If you earn your income and pay tax on it, and you go to the grocery store and buy a loaf of bread and a jar of peanut butter, we don't have another income tax as you sit and eat your peanut butter sandwich. If you buy a television, you can watch the programming and there's no income tax on the programming. But if you buy a bond, we tax the interest. If you buy a stream of dividends by purchasing a share of corporate stock, there are 2 taxes. One at the corporate level, and then again a tax on the dividend. And if they reinvest the money and the stock price goes up and you sell the stock, you pay tax on the capital gain. So the returns on capital are taxed at least once more, sometimes twice more. And then there's the estate and gift tax. Most of the money in an estate is, of course, stuff that you have earned in the past and saved and paid tax on before. And as it earned income, it was paying tax again, and then we tax the actual asset amount if it's over a certain amount when you pass away. Well, the way to get around that problem, if you want to go to a neutral tax system, is to take these basically 4 steps. When you buy plant and equipment, you write it off immediately. You don't depreciate it over a long period of time. Note that's sort of the way we treat IRAs. You take a deduction for the saving and then we tax it, the money when you take it out. Well, if you expense investment and then tax the returns, you're treating it like an IRA in effect. That's the right way to do it. The second point is to make saving either tax deductible as an irregular IRA and then tax all the returns when you take them out, including the earnings. Or you make it non-deductible as in a Roth IRA, but then you don't tax the subsequent returns the same way you don't tax the loaf of bread and you don't tax the peanut butter. Finally, 2 more points. Integrate the corporate tax with the owner's tax so you don't have this dual taxation of the dividends and the capital gains relative to interest. And finally, end the estate and gift tax. It brings in very, very little. It's got a very high tax rate on a very, very narrow base, and it's incredibly distorting. Now, our tax system has two kinds of elements in it. It has, I skipped one. Here are your 2 key concepts. Professors Haig and Simons in the 1940s were trying to help the government define what is income. We have this income tax. It's going up during the war. What is income? What should be in and what should be out? So they came up with a concept. We're going to tax the change each year in your ability to consume. Now that comes from your current labor income. It includes any earnings you have on your past saving. If your stock price goes up, you could sell it and consume the increase. So they put in capital gains as accrued. And they advocated for depreciation rules, something called economic depreciation, which I'll get to in a little bit later. Now, this system has the attribute that returns on saving and on investment that only equal the time value of money should be treated as income, even though they're merely compensating you for the penalty you get by having to wait and tie up your money. And since people don't think of a dollar 5 years from now as being as valuable as a dollar today, this does kind of hit them between the eyes. They don't think they've earned anything, and you're saying they have, and you're taxing it. So they don't adjust anything for the time value of money. The reason they wanted to tax capital more heavily was they wanted more redistribution. And in Simon's book on the income tax, he explains that this was his motive. And this leads us to what we normally see in what's called a pure Haig-Simons income tax. The other concept is something more akin to what I think people look at if they're in business or if they're ordinary people, and they're saying, well, income is your revenue, but you have to subtract the costs of earning it. If you're a grocery store and you're selling the case of soup for $20 and you had to spend $15 on buying the case of soup, you've only made $5 in profit, not 20. Okay, so that's revenue minus the cost of earning revenue. It hits labor income, and it hits the earnings on saving and investment, but only after you've deducted the full cost of obtaining these earnings, which means deferring the saving and expensing the equipment and the buildings. And cutting down, expensing the cost of all the materials that you've put in, all the electricity your factory needs, all the state and local taxes on the factory, and the cost of tuition and training, because supposedly as you go to pay for an education, you're going to be earning more money as a result when you get out. And so that's a cost of earning future income. Now, education is a bit of a gray area because sometimes you take courses in art appreciation that do not lead to further income in your career as a computer programmer. So there's always a consumption element to higher education, but generally speaking, you probably should be allowing a deduction for tuition. Now, this reflects the time value of money because it doesn't double tax the saving and the returns on saving. It doesn't partially allow a deduction for plant and equipment. It allows a full deduction for plant and equipment and taxes the returns. And this was proposed by economist Fisher, and his goal was to maximize output and income by not distorting the savings consumption choice. Now, our income tax system is kind of a hybrid. We have elements of both types of systems in it. The income elements include, we have saving that doesn't go into a pension or an IRA. It's taxed as you earn the money and save it, and then we tax the returns as well. That's ordinary savings treatment as an income tax approach. Depreciation and amortization, long asset lives stretched out to sort of match the life of the asset in service that in present value don't equal the full cost. This is an income element, as Haig and Simons defined it, and as the accountants define it. The consumption elements are the tax-deferred Roth and IRA systems and the pension systems. The tax-exempt bonds, they're like a Roth IRA, right? When you buy a municipal bond, you don't get a deduction for it, but we don't tax the interest. The treatment of owner-occupied housing before the last tax bill and before all the limits on mortgage interest deductions were treated very much like a Roth IRA. You didn't get a deduction for buying the house, but we didn't tax the imputed rent that you pay yourself for living in it. So the purchase was not deductible, but the returns were not taxed. And then accelerated depreciation or expensing provisions that we have had in the code at various times are more like a consumption element than an income element. Now, depreciation is one of the key drivers in deciding how much capital to form and how many workers to hire and what to pay them. And there are several concepts of depreciation. There's economic depreciation. Haig and Simons said, well, we're going to tax the change in your ability to consume. Suppose you buy a machine and then you sell it next year, you get some of your money back, so you haven't really lost all of it. So the only change in your ability to consume was the year-over-year decay in its value. And that's all we let you write off each year. Straight line depreciation says, okay, take the $100, and if it's a 5-year asset, write off $20 a year. That may or may not equal economic depreciation, but maybe it's close. Then there's accelerated depreciation. You've heard of some of them, the double declining balance method, the sum of the years method. These all move some of the write-offs closer to the beginning and tail them off further toward the end, either on the assumption that things decay faster when you first buy them, like when you drive a car off the lot and then immediately it loses a lot of value. But it doesn't go all the way to expensing. And then there's expensing, which is the immediate write-off, which reflects the full-time value of money. What do we mean by the time value of money? When I lock up $100 in the machine this year, it's gone. I can't use it for anything else. I've given up all the opportunity cost of the other things I can do with the money. To me, that money is out the door now. If I keep the machine until it dies and get nothing back for it, I really had that whole $100 tied up right away. That's when I spent it, not in dribbles over the life. So that reflects the time value of money. Now, the generally accepted accounting practices, the GAAP, assume economic depreciation. They assume the Haig-Simons concept of income. And with acceleration of depreciation or expensing, the GAAP rules say, okay, you've gotten more write-off today, but you're going to get less write-off next year and the year after because you took more now and less later. So we're going to make you tell your shareholders that, okay, our profits are higher this year, but we're going to have a deferred tax liability next year. And so if we've saved $1 in tax today, but we're going to owe $1 in tax next year, we're going to have something on our income statement which says deferred tax liability. So you get +1 here and -1 there, and there's no benefit to you from the accelerated depreciation on the income statement as the accountants make you report it to your shareholders. But a tax deferred and a $1 of profit brought forward a year is of value to the company. GAAP doesn't get that. They don't adjust the future tax liability for the decay in its value by the time value of money. They don't show the tax saving to the firm. On the other hand, if we cut the tax rates by a sort of equal amount, they will show that immediately. And there are some CEOs who say, well, accelerated depreciation is really good for my company, but it won't show up on the return and I can't announce it at the shareholders meeting. So I'd rather have the rate cut because it shows up right away and I can make a nice statement at the annual meeting. They're pushing things that are worse for their shareholders because they look better for the management. And that's what happens when you have these games in the accounting. And people came in to the House and the Senate and said, we want rate cuts, we don't want accelerated depreciation because it doesn't show up on our financial form, even though it's better for us. Now, there are other reasons why some firms would prefer one over the other, but that was one that was floating around, and it was really not cricket. Okay, here's the rationale for the economic depreciation. If the asset is losing value each year, because we know it's going to wear out or become obsolete within 5 years, and each year we get further on and it has fewer years of useful life and less future income coming in, the value of the asset is the discounted present value of the future income. So if there's less coming along in the future, because we know it's going to have to be scrapped soon, the price falls each year. And so Haig-Simon said, let's just take a look at each price reduction and only allow you to write that much off, forgetting that you actually had to pay for the whole thing up front. That was the rationale for economic depreciation. But most firms don't buy a machine this year and sell it next year to get their money back. They keep it. And so the opportunity cost is fully realized in the first year. That's what we should be counting. If you make people wait to take their write-offs, they become exposed to two things. First of all, there's the delay. And then there may be inflation on top of that. We don't index the depreciation allowance for inflation. We would under a neutral cost recovery system, but we don't under current law. So here's a 3, 7, and 39-year asset. If you expense it, you're writing off $1 for each $1 you spend. If you have the old MACRS system without any of the expensing in it, you would only write off 96 cents in present value if inflation was 0, and only 92 cents if it was 5% inflation. That would be the present value of the write-off, less than 100 cents on the dollar. The longer the asset, the worse the effect of time value and inflation get. At 5% inflation on the 39-year building, you're basically getting a deduction that's worth only 30 cents for every $1 you put into the building. And the building has to earn 70 cents more to make up for that. And if that building isn't going to be that profitable, you don't do it. So there's more of an impact on the buildings than on the short-lived asset. Now, does that matter? Well, let's take a look at some history. In 2001, we were on the verge of a recession. People were beginning to sense this, and Mr. Bush came up with a 2001 tax cut. Larry Lindsay put it together for him. And it focused really on cutting rates for individuals. And that was phased in over time, and there was nothing for business. And I said, Larry, you need to do something with depreciation. We're going to have an investment crunch. And he said, oh, well, we spent all the money on the personal side, but when the Keynesian stimulus from the tax cut comes in and it lifts the economy, we'll have some extra revenue, and then we'll do something with depreciation. It's too complicated to explain during an election. I said, Larry, you're not going to get a Keynesian lift. And you've done nothing to prevent the drop in investment. And we did not get a Keynesian lift. Demand did not get pumped up. Why not? If the government cuts taxes without cutting spending, it has to borrow the tax cut back. The people really don't have any more money to spend. There's no demand lift from it. The whole demand management concept is obsolete. And sure enough, we had the recession. Equipment spending in green fell. The structures went down. And in 2002, Congress said, oh, we got to do something. So they came up with the idea of letting you write off 30% of your investment in equipment immediately and depreciate the other 70. It was sort of a different approach to the old investment tax credit, which they used to put on in recessions and take off in booms. Now, expensing really belongs in the tax system on a permanent basis, but they were putting it in on a temporary basis. It doesn't work as well on a temporary basis because you know that if you buy the machine, when it wears out, the expensing won't be there and it'll be more expensive the next time and maybe you won't bother. But it does help a little bit by moving some investment a little bit forward in time. So what happened after the 30% expensing provision in 2002? In the very quarter it went into effect, the drop in equipment spending leveled off. And structures weren't eligible and they continued to slump. And then in 2003, Congress says, uh-oh, this is getting serious. So they took all of the phased-in tax cuts that were still to be coming, and they moved them forward to 2003 on the individual side, and they moved the bonus expensing up to 50%. Equipment spending took off like a rocket, and structures stopped dropping. When you cut the individual rates enough on the proprietorships and partnerships and subchapter S people who had apartment buildings and shopping malls, at least they got lower rates. They didn't get bonus expensing, but at least the tax rate on the assets was reduced, and that stopped dropping. So that business provision was extraordinarily important in preventing the recession from lingering much longer or getting worse. We saw a simplified version of this chart last time. We had the capital stock on the upper left, the labor supply on the lower left. They come together, they produce a product, and it gets sold. And that's what we showed you. And we said that if we can determine how much labor and capital we have, we can tell you how big the output is. Now the question is, what happens when you sell the output? Who buys it, and what happens to the money? And those are the green arrows. Somebody buys the output. There are payments to capital, and there are payments to labor. Labor and capital get their pay. Then over on the far left, they get their money and they go off, and on the green arrow, they go and buy something with it. That green arrow is this green arrow. It goes around in a circle. Pretend this is on a soup can and you can bend the label all the way around. This goes around and around in a circle. It's called the circular flow of income. Now we can tax this at any point to grab some of this flow of income for the government to spend so that it can hire some of the labor and some of the capital for its purpose. Okay? We could put a sales tax at the point of final sale. We could have a payroll tax on the paycheck. We could have a corporate tax up here. We could even split the sales tax into pieces at each stage of production. That would be a VAT. When the payments go through the corporate sector to the shareholder or to the owner of the pass-through business, it could be taxed on the income tax as pass-through income, dividend, capital gains, and interest. And down here, we can have an income tax on the wage payment. And various types of tax systems use some or all of these and weigh them more heavily in one way or another. Some countries may rely more on the sales tax or VAT, others may rely more on the corporate tax, others on payroll or social insurance taxes. Now, in the real world, of course, some of our spending goes to buy imports, and some of these purchases are coming from abroad, and you could do another loop with the balance of trade. But I want to get back to this idea that the government can tax and spend and do no harm, the demand management notion. When you put these taxes on, most of the circular flow diagrams don't have these little tax boxes in them. But wherever you've imposed that tax on that section of the flow, it acts like a constriction in the garden hose. You're twisting the hose. You're tightening the flow that goes through it because you're raising the cost to the buyer, reducing the reward to the seller. And whether it's output or inputs, you are reducing the reward to doing whatever they're doing. And there's that triangle we went through in a previous lecture where we had the chart on the imposition of a tax. And the demand management side completely forgets about the deadweight losses and the constriction of the activity. So even if the government takes the money away and private output shrinks and the government spends some money to buy up the resources that weren't used now, the total quantity of the resources has shrunk. It never makes up for the fact that they took money through taxation. The deadweight losses are still there. And that's the problem with these income-ish taxes, particularly the ones that hit capital harder than labor, because the capital shrinks more than the labor force. Capital can move abroad, or we can decide not to invest or save. We can go out and buy something and have some consumption instead, and that means future capacity is reduced. So, within all of this, there are some key points. I want to talk to you a bit about the tax treatment of interest. In that circular flow diagram, what you're seeing is that part of that capital is being paid for with borrowed money and part with your own money. When you sell the output, the revenue comes in for the whole value of the output. Now you're paying your wage earners, but you have some flow left that's coming to the capital. If it's all bought with equity, the owner of the business gets the whole return. But if some of it is borrowed money, then some of the return has to go to pay the interest to the lender because the lender helped you buy the machine. Now the owner of the capital gets the whole write-off for the machine, but he still has to give some of the receipts from the sale of the goods to the lender. And in the normal circumstance, before the last tax bill, the business would deduct the interest payment from its flow of funds coming in and say, this isn't taxable to me, I'm paying it to the lender, and he's paying tax on that part of the flow. The remainder of the flow stays with me, and I pay tax on that. So the whole flow is being taxed, it's just not all being taxed at the business, part of it's being taxed over at the lender who helped buy the machine. Now, what happens in that situation? Suppose the pre-tax interest rate is 6%, suppose everybody's in the 33 1/3% tax bracket, just to keep the number simple. After-tax interest is 4%. If I borrow, I get a deduction for the interest payment, I'm paying out 6, I'm saving 1/3 of it on my tax, it's only costing me 4% after tax. What's the lender getting? Well, he's getting 6, but he has to pay 1/3 of that to the government. And if they're of equal size, it's a wash to the government. Because what it loses on the deduction, it picks up on the other side when the lender pays tax. Now, if interest is not deductible and not taxable, if you just take it out of the system entirely, the interest rate drops to the 4% after-tax return. The borrower is still paying 4%, as he was before. The lender is still getting 4%, as he was before, but the complexity of taxing the interest is gone. Now, what if you pick and choose and try and be clever? Suppose it's half in and half out. Suppose we cap the interest deduction on the borrower's side, but we fully tax the interest again on the lender's side. Now, the lender is still demanding 6% because it's taxable, but the borrower is not getting to deduct. So on the portion of the interest that he cannot deduct, he's paying the full 6%. So his after-tax interest cost has gone up. And that's what we did in the last tax bill in order to raise revenue to help cut the rates. Now, ironically, taking interest out of the tax system actually raises revenue. Can you think why? Most of the borrowers are taxable and are deducting their interest, but some of the recipients aren't taxable. So some of the interest isn't taxed. The Harvard endowment is not taxed. Charities are not taxed. Foreign central banks are not taxed. some cases under tax treaties, foreigners are not taxed in general on what they earn here. So the amount of interest on which we're collecting tax is smaller than the amount of interest that we are deducting tax. So if you flip the treatment from normal to everything out, the tax base goes up. But the after-tax interest rate to the firm doesn't change, so it's not harmed. The free riders, the tax exempts who get the market taxable interest rate but don't owe tax on it, now find that the market interest rate has gone down. They're the losers. Okay? Now, this matters primarily when we're talking about a key provision of the last bill. When you have expensing, some people say, uh-oh, if I'm writing off the full value of the machine right away, and if it's only barely earning its own money back, and we don't really have a net real profit very much, then the tax is almost zero to begin with. And supposedly, investment competes away its returns until driven down to barely the 3% real after-tax return. It doesn't really happen, but if in theory that's what people think, but there's not much of a tax being collected in the first place. And now if I deduct the interest, that borrowing business, that leveraged business is going to have a negative tax rate. So if you have expensing, you can't allow them to deduct their interest. But they're forgetting the lender was paying tax on it. There's no negative tax rate, not when you put the two together. Well, that stopped them for a while, but then they said, oh, but wait a minute, Harvard Endowment doesn't pay tax. And the Central Bank of China doesn't pay tax. So part of that income isn't being taxed. So it's okay to deny part of the interest deduction because that's only reflecting the thing is that we're over here, we're not taxing all of it. But when you do that, the business faces the higher borrowing cost of having to have no deduction for the interest. He's paying now the pre-tax rate instead of the after-tax rate. So why are you punishing the borrower? Because you let the Harvard Endowment not pay tax on its interest. Now, if the Harvard Endowment not being taxable actually lowered the interest rate by making them save more, then maybe the business is getting some of it back with a lower interest rate. But the Harvard Endowment is not the marginal lender in our economy. You see, there's something going on up in Harvard. The endowment is raising money and they're using it for scholarships and paying the professors. And if the Harvard Endowment said, hey, this industry just got a tax break and the stock market's going to go up, let's not give you any money this year, let's invest it in the stock market instead and cut our contribution down to Harvard's annual budget. The professors would complain, the students would complain, the deans would complain, they can't do it. And the charities are forced to pay out what they take in, except for a very small margin. And the Central Bank of China isn't in there to play the stock market, they're doing it for foreign exchange reasons. These are not the marginal lenders, and everything works in the economy at the margin, and the marginal lenders are taxable. The argument that you should not allow a deduction for interest because you have expensing is entirely phony. Now, there's one other point that sometimes you hear. I heard it just the other day from a leading economist in the city. Oh, but those pensions don't pay tax on interest. Most people have money in their IRAs, they don't pay tax on interest. They do when they take it out, and they pay tax on that interest with interest, because the inside buildup is fully taxed. The government gets its money back later with interest. And the rates of return in the private sector are higher than in government bonds, so the government's actually making out well. So these are false claims. Now, the tax bill raised the tax on interest and lowered the tax on equity. And another reason they thought they might do that, well, first of all, they wanted the money so they could comply with the Senate rules, right, on not having any 10-year window hit on the budget. The Byrd rules. Anything beyond that was a no-go. So they raised revenue to lower the rates. But there was also this other concern, debt versus equity. We're treating equity worse than we're treating debt. We should equalize it. Maybe that's a good thing by itself. Well, if the equity is being double taxed, and if that's not good, and the debt is being taxed properly, why are you meeting in the middle? Why not get rid of the double tax on the equity by integrating the corporate and the personal taxes? Why are you implementing some double taxation of the debt to meet in the middle? It's like you walk down an alley, you get mugged, you're tugging on one side of your wallet, and the mugger's tugging on the other side, and the cop on the beat comes and says, guys, why don't you just split it down the middle? No. One was right, one was wrong. don't meet in the middle. Okay. The difference in tax rate between debt and equity does affect the leveraging ratio, though. If the rate of return on equity is that flat, roughly 3% real after-tax return, and the debt is treated better, then take the far right line, and that difference in the height will be, the bigger one will be the difference in the treatment of debt and equity when you have just a little bit of debt, and there's a high tax differential, high tax rate on equity. Then you're going to have some additional borrowing, but you can't just borrow everything. You become too highly leveraged. You become a risk to the lender. You might not repay. If there's a recession and your income falls, you might not be able to make the debt payment. As you do leverage more highly, your new borrowing is going to receive a higher interest rate demanded by the lender because your credit rating is going to be slipping. And if you have additional debt, and you have to pay more on your new debt, then when your old debt comes over and you want to roll that over again, it's going to jump up to the new higher interest rate. So the market interest rate on your new debt doesn't take into account that you're sort of poisoning your chances to roll over your old debt. So the marginal tax rate on interest actually rises quite steeply for businesses. And at some point, it crosses the equity line and they stop. So with a high tax differential, we're going to get a lot of debt and a little bit of equity. But with a low tax differential, you're going to get less debt and more equity for the same total. And that assumes that in creating the differential, you've actually lowered the tax on the equity while you've raised the tax on the debt, and it's a zero net tax change. If you just raise taxes in general, of course, you would get less total. But the split between the two is determined in this way. In our model, we cannot tell, no one can tell, what the marginal cost of debt borrowing is, because they don't see the effect of the new debt poisoning the old debt. We don't really know. And we don't know the risk tolerance of the businesses for being over-leveraged. You can get into trouble being over-leveraged. Remember Bear Stearns and Lehman Brothers and the financial panic? So there are limits to what you can borrow. But we can't tell what those are from the market interest rate because we don't know how each firm is affected and what it thinks its risk-adjusted interest rate is. It doesn't show up anywhere. So we just use the equity as the cost of capital, and we assume they have split between debt and equity according to how that best serves them and reflects their liquidity and situation of their lenders. Now, we have 4 types of neutral taxes. And they pick different points in that circular flow where they're imposed. Some are imposed at the point of final sale, some are imposed in stages of production, some are only imposed where the payments are made to the factors of production. And you should think of them, they're all neutral. They all eliminate those extra layers of tax on capital. The only thing is the collection point, the ease of collection, the ease of compliance, whether the taxpayer can see the tax clearly and knows what you're taking from him so he knows how to vote, visibility. Those are the criteria on which you have to judge between these, convenience and the political economy goal of in a democracy, letting the voters know what the government is doing to them and what they're paying for what they're getting, and let them decide on how much of whatever they want. So we have a national retail sales tax, a value-added tax, the so-called flat tax by Hall and Rabushka, or Dick Armey, and a personal expenditure tax, a cash flow tax, consumed income tax, David Bradford's X tax, which has been taken over by AEI, and what I call the Inflow Outflow tax, which Norman Turre and I developed a few years ago. These are all taxes collected at different points, but they all achieve the same neutrality. They all have expensing. They all either defer taxes on saving or tax the returns, not both. They don't tax it at both ends. They all get rid of the estate tax, so forth. So they get all those boxes checked. Now, here's the comparison of a sales tax and a value-added tax. These are almost like 2 peas in a pod. They're very, very similar. Suppose I have an industry where they dig iron and coal out of the ground, turn it into steel and auto parts, and build an automobile and sell it to the public. If I have a retail sales tax of 10%, and I've got $6,000 in coal with another $12,000 worth of labor and capital in the steel industry and another $9,000 added on in the automobile industry. The only place I tax this whole thing is on the point of final sale at the $27,000 at 10%, $2,700. With the value-added tax, they do it differently. They tax the $6,000 at the iron and coal stage, $600. Then when they sell it for, when the steel and parts people take the $6,000 and turn it into $8,000 worth, $18,000 worth of output, which they sell to the auto company, they tax the difference between the $18,000 and the $6,000, which is the value added by labor and capital in the steel and auto parts industries. And that's taxed at 10%. And then when they sell it onto the automobile industry, and the automobile industry adds another $9,000 in value to get to the 27, the auto industry is going to owe $900 in tax on the $9,000 that they added. And if you add up the $600, the $1,200, and the $900, guess what you get? The same thing. But you've collected it in stages so that if any stage somebody cheats, the government's still picking the money up on the next stage. Why? Because the way the value-added tax works is when you sell the goods for $12,000, you pay $1,000. When in the second tier, when you sell the goods for $18,000, you first pay $1,800 in tax. And then you show the government that when you bought the raw materials, you had paid $600 in VAT that was collected by the firm below you, and they give you a rebate for the $600. And the $1,800 minus the $600 is the $1,200. So that if the first company didn't bother to send in the $600, the government would have a paper trail, and they could go after them. And if you didn't have the receipt, you wouldn't be allowed to deduct the tax to the earlier firm. So they're making each firm police the firm below them, in effect. Now that's a lot of a burden on the business, and the easiest way to collect the VAT is to say, all right, you sold it for 12, it cost you 6, you sold it for 18, it cost you 6, we're going to tax you on the 12, just send in the $1,200 to begin with. Don't bother sending in the $1,800 and getting the $600 rebate. But then the IRS has to do a little bit more work to check up on your supplier. So this is a way of pushing some of the administrative burden onto the people being taxed. But either way, you get the same numbers. Both of those taxes are border adjusted. A sales tax is rebated at the border, and anything coming in is taxed at the sales tax rate. You all know this from the European experience. And if both sides have the same sort of tax system, then there's only the same amount of tax being collected on an import or on a domestic product sold at home. It's destination-based. Where you sold the product determines where the tax is calculated and levied, not where you produced it. Something like that was put into the original House proposal. They were going to make the corporate tax border adjustable. They were going to give it on the exports, and they were going to tax it on the import. And the retailers went nuts. If they're importing retail goods and they can't deduct the cost of the import because it's going to be fully counted as taxable, oh my God, all the import costs are going to go up. They'll have to go out of business. Well, no. When people put on these taxes, the exchange rates move to keep the relative prices the same. Oh, they won't move. How do we know they'll move? They can't move that fast. Exchange rates have moved enormously, 20, 30, 40, 50% within 18 months or 2 years, many times in the past. And if you look at the European nations, after they put on their VATs, they still had department stores in every country, and they were still selling products from everywhere. This was a phony concern, but they were irrational and hysterical, and they didn't want it, and it came out of the bill. Now, if you switch from a tax which you impose where the thing is sold, which is like a VAT or a sales tax, destination-based tax, and you switch to a tax that hits you where you produced it, you've got to worry about where you're allocating your costs. And you've got to worry more about income shifting and all the games that can get played by overcharging or undercharging your suppliers here or there and moving money between your domestic and foreign accounts. So we end up with the GILTI, we end up with the BEAT, we end up with FDII, we end up with a lot more rules because you can't do the border adjustment. Now, this is a different type of tax. The flat tax is the Army tax. Army is flat for two reasons. One, his tax base is flat. You don't have all those double and triple taxation of savings and corporations and the death tax. But the other thing is that he had one flat rate. Now, you could do the flat tax base, which is flat, but you could have graduated rates, because there are two types of flatness in the flat tax. You can give one up for progressivity. What the flat tax did instead was to have a very large exempt amount at the bottom. So a lot of people wouldn't pay any tax, and a lot of people with just a little bit income over the threshold would only pay a little tax, and then people would pay more at the top. But this has the effect of dropping an awful lot of people off the tax rolls, and they think the general government is a free good, and it isn't. So that's probably not too good. But in any event, they did get their tax base right, pretty much. Suppose you have a business which, after buying all of its supplies from its suppliers and so on, which means you're expensing all your equipment purchases, among other things, you have a value added on your sale of $300,000, and $200,000 of that goes to pay cash wages, not fringe benefits. They're kind of complicated to allocate to the individual. So the Army said, let the business pay the tax on the fringes and on its profit. So that's what's in the $200,000. It's only the cash wages. And what's left is the taxable business income, and he had a flat rate of 19%. I've just said 20 to keep the arithmetic simpler. Now on the personal side, labor is deductible. It isn't in a VAT. VAT hits the labor and the capital right at the business and then doesn't charge anybody below. But the flat tax passes the wages on to the individual to be taxed, and that lets you put in an exempt amount to shelter the lower income wage earner. So suppose this firm has 4 workers getting paid $50,000 in cash, and that's the 200. And then there's a family allowance, and that's the taxable portion of the wage earner's share, and at a flat tax rate of 20%, that's $4,000. If there are 4 workers, that's $16,000. If you were taxing the full 200, you'd be at 20. The difference is because of the large exempt amount on the wage side. But you see, this involves expensing and no double taxation according to whether you're corporate or non-corporate. So all businesses are treated alike. You don't have that problem. Now, it's not border adjustable, but when you think about it, this is the money you've got after all your taxes. When you go to the store, you're not having a sales tax, because it's not a VAT. It's neutral, but it's not a VAT. So you're buying your money with after-tax, you're buying everything with after-tax income. So in a sense, whether you spent it on the import or you spent it on the domestic good, they've both been taxed equally. So it's neutral too. You don't need the border adjustment here. This is my favorite tax, the inflow outflow or the cash flow tax. It doesn't fit on a postcard like Army's, but it is a bit more attuned to who actually got to spend what. And the other great virtue of it is you see it. Once a year you sit down and fill out a form and you say, they took what? I didn't want them to spend that much, I'm not going to vote for them. Or, gee, that was cheap, we should do more, I'm going to vote for that. But at least you know. And that's the key benefit of this. The inflow outflow tax says, put down your income, subtract your net saving for the year, and pay what's left. Pay on what is left. It's the revenue minus the cost of earning the revenue approach. It's on the individual form. All businesses are passed through. They will tell you how much they gave you in dividends, and if you put it in the bank and didn't spend it, you get a deduction for that. When you take it out later and spend it later, then you pay tax on it. So the system works beautifully, and it's very simple. Here's all my income, from wages, from interest, from dividends, from capital gains, from whatever, from welfare payments I receive, from gifts I receive. You get them on W-2 forms. There are deductions. This one is for saving, which I'll show you in a moment. Did I add to my saving that year, or did I subtract from it? I'm not asking whether you sold stock and bought stock and how much of a gain there was in each sale. I'm going to say your broker is going to tell you at the end of the year, you sent in a net $3,000, or you withdrew a net $1,000. I don't care what went on during the year. That was your addition or your subtraction from your saving. That's all you need to know. No capital gains calculations. So you subtract your saving from your income, and that's that stage. But then we do have some itemized deductions. Unlike Army, that took away almost everything except charity and mortgage. There are some deductions that are there for a reason. I'll get to those in a moment. Well, you take those off, and then you have your taxable income. You have an exempt amount at the bottom, personal exemption sort of thing for the poor. And then you've got your income, you pay your tax on it, and that's the end of that. Now, I said there were some itemized deductions, and there's a reason for that. And some of you aren't going to like some of them. Norman Torre's idea was we want to tax the income to the person who actually got to spend it. If income is being taken away from me, suppose I owe alimony, and the ex-wife is getting the money, she's spending it, I'm not. I should deduct it, she should pay tax on it. That was the way things were until just last year when they decided to flip it because the IRS was having trouble tracking who was fessing up to getting the alimony. But really, that really is the right way to do it. That's the same rationale for charity. If I'm giving money away to somebody, they should pay the tax on it, not me. If the town is taxing me to fund primary schools and secondary schools, and the children are, in effect, paying tuition through the tax system, and if tuition should be deductible, then that's most of my property tax. The remainder goes to police and fire, and they prevent casualty losses that I would otherwise incur. That should be deductible. This is not consumption. The property tax should be deductible. Bradford thought it shouldn't. He thought police, fire, and schools were consumption, but they're not. Even Bradford, David Bradford, who is trying to minimize deductions, thought, well, you know, the state tax, what do you get from the state? They run the court system, okay. They fund the state universities, but remember, tuition should be deductible. But then most of the rest of it is welfare. It should come off my tax return and go into theirs. But they're too poor to owe tax. So be it. It shouldn't be taxed. So he allowed the state tax deduction, but not the local. We would allow the local as well. Then there are gifts in charity, and you give that away. And then there's qualified tuition training, tuition to help you earn more income. And that's, again, I said it was a gray area because if you take art appreciation, that's not going to help you to become a better computer programmer. But anyway, so these things would be added up and deducted, and you'd simply take those off as your itemized deductions. There's not much there that's hard to do. Now, okay, here's your Schedule B, your saving. I took $1,000 out of the bank. You have your checks deposited from your pay, you take some out and you write checks and back and forth, hundreds and hundreds of transactions. I don't care. I don't care about that. All I want to know is what was your net at the end of the year, and the bank will give you a statement saying minus 1,000 or plus 4,000. And that's what you put on that saving line on the previous form. Very simple. Here's your business tax. Very simple. I have $100,000 in sales. I have purchased $50,000 from other businesses or what have you. I have paid the electric bill, I have paid the property tax, I have bought my raw materials, I have bought my inventory. I have subtracted my labor compensation, and I have $20,000 left over. The business won't pay tax on the $20,000. It will either pass that on to the owner if you have a subchapter S or a partnership or a proprietorship, and that will show up on the owner's Schedule C, as now. If it's paid as a dividend to a shareholder, it will be deductible. Dividends are deductible. And the shareholder will report that as taxable income unless he puts it into his saving and bumps that up by the $20,000, in which case it would be tax deferred. That depends on what the shareholder chose to do with it. If the business doesn't pay it out but retains it and puts it in its own bank account and is intending to spend it later, that is saving. Bank account of the business went up, and the bank will say, plus 20, deductible. So all the businesses, corporate, non-corporate, they're all pass-throughs. You don't have to worry about the differential in treatment. There's only one exception here. This is also not border adjustable because when you take your after-tax money to the store, the import and the domestic good are both taxed the same because we taxed you before you got there. If the $20,000 were invested abroad, we don't want to bother with collecting information from overseas. So we simply say, Roth IRA. You pay tax on that $20,000 right now, send it abroad, we don't care what happens. And that's a tax that you can't distribute to the shareholders. When you bring the money home in the future, might have gotten bigger, might have gotten smaller, whatever. When you bring it in and put it in your bank, in the business's bank, it's a deduction again. So that's a wash. Now, if you use that repatriated income to earn more money here, that is taxable here. But what happened in between, we don't care. We don't need to have tax treaties. We do about definitions as to whether we're withholding on foreign investors, but we don't need nearly as much of a problem with the international side with this sort of thing. So this is fully visible to the taxpayer. All businesses are treated alike. You don't have a border problem nearly as much as you do under current law. When President Bush called for a tax reform panel in 2005, I think it was, or 6, they came out with a report which looked at a simplified income tax, and they put it next to a growth and investment plan which had expensing and was sort of most of the way toward a consumption base. And then they went to a full-blown cash flow tax and VAT and national retail sales tax. The growth and investment tax plan has a lot of features in it that were in the House version of the bill and are in some of what we just passed, including the expensing. But they had interest removed from the tax system. That was the flip, which raised that revenue because some of the tax exempt organizations were not getting their free ride, and because it would lower interest rates on treasury bonds, because they wouldn't be taxable anymore. The government would save on the spending side as well. So you can read up on that sort of in a side-by-side. Now, some people turn to the tax expenditure tables to look for things to grab, to pay for tax cuts. There are a couple of reasons why you shouldn't do that. One is some of these tax expenditures only apply in a pure income tax, and we have already decided we don't agree with that part of the income tax. When you ask members of Congress, do you think an IRA is a tax expenditure? Do you think a pension is a tax expenditure? They say no, but under a pure income tax it is, so you don't want to use that part of that list. The other reason for being careful about using the list is that when they put them together, they say, what would the tax system look like right now if this had never been enacted in the first place and all the adjustments had been made in behavior? But if you remove them today, it may take several years for the behavior to change. So the 10-year budget window cannot be found simply by looking at the tax expenditure and multiplying it by 10. You'd have a phase-in and phase-out adjustment period, and it would be quite different. The way joint tax would score it quite differently from the way the tax expenditure list would show it. So be very careful when you use that sort of thing. Well, let's look at a few of these things. What about expensing? The Haig-Simons income tax says, no, you should use economic depreciation. That's a tax expenditure. The consumption base says, no, that's normal. You have to allow for the time value of money and have the full opportunity cost reflected. What about accelerated depreciation? It's sort of like expensing. Income tax says it's too fast. Consumption tax says, no, it's not fast enough. It's a negative tax expenditure. Then we have saving plans and pensions. It's a tax expenditure under a pure income tax. It's normal under a consumption tax. And in fact, if you don't have full access to them, if the amounts deposited are limited and you have to start taking them out when you don't want to, that's not going far enough. It's a negative tax expenditure. Reduced tax rates on capital gains and dividends. That's a no-no under the income tax. They want the full double taxation. And it's normal under the consumption base. In fact, it doesn't go far enough. I will say this, though. Even Haig and Simons thought taxing the corporate income and the dividend was going too far. They wanted to tax accrued capital gains and dividends and not tax the corporation. They wanted it to be a pass-through. Child credits, the EITC, these are considered tax expenditures for social purposes under both systems. The corporate tax, Haig and Simons didn't like it, but in the usual way we think of income taxes today, we say, well, we don't have to worry about Haig and Simons, we're going to tax them anyway. If the shareholders are taxed and you don't have expensing, the consumption tax would say it's going too far. What about the standard deduction and the personal exemption? The government just isn't taxed. We view that as normal in the income tax because everybody thinks they should have something like that, although we just eliminated the personal exemption. These are tax expenditures in the consumption tax. You have the money, you spend it, you're consuming it, you're not taxing it, it's a tax expenditure. But if you had a progressive consumption tax and were deliberately trying to put some of that into it, some progressivity into it, you'd go along with the general consensus that we should have an exemption for the poor. Then there's the graduated rates. We hear some very peculiar arguments here. Under the income tax, if your top rate is 37, then anything less than that we collect from lower income people is a tax expenditure. It's not the full rate. It's bizarre. On the consumption base, it's, well, gee, you have a basic tax rate on consumption, but then you start charging some people more for their consumption than others. But if they go into the grocery store and they each buy the same loaf of bread, they're taxed the same thing under a sales tax. Why would the graduated rates, would you put more tax on a person buying the same loaf of bread? That's considered to be a negative tax expenditure. Then there's the deduction of interest. I've told you the two ways you can tax interest reasonably. And so in both cases, it's normal to have a deduction for interest if the recipient is being taxed, but not if the recipient isn't being taxed at the margin. So you can do it either way. And then you have credits for the environment or low-income housing and all of these things. They are considered tax expenditures under the income tax. Now, the consumption tax would like to see everything expensed, so you're giving them a credit and they're not expensing, so kind of you're making up for it, but you're only giving it to some things and not to others, so it's considered to be a very awkward kind of quasi-tax expenditure because it's uneven. And then there are hundreds and hundreds more on the list. So the key point there is, if you have an idea of what the tax base is that you're trying to achieve, there are rules for getting to each kind, and bear them in mind. And when you start picking and choosing and mixing and matching and you lose your principles, you may get to a point where you're looking at something and you think, yeah, you should tax that. If you remembered your principles, oh, wait a minute, no, I'm not supposed to tax that. It would give you a guide as to what you do so that your tax systems are internally consistent within the tax system and toward whatever objective you're trying to reach. And you have to sort this all out. So it's not a simple field, and we've covered a lot today. I hope I have given you some idea of what to look for and an idea of setting your goal and your principles down first so it can act as a guide for you. As I mentioned last time, the consumption base for the same revenue raised will boost GDP by almost 10% and will boost wages and employment and living standards. And if you can find some other way of assisting the poor rather than going through a tax system which beats up on capital to try to raise the extra revenue, if you have a progressive consumption base, or if you could have family payments that don't go through the income tax, you can make these things progressive, but without doing the added damage to capital formation versus consumption that comes with income tax base. Questions?
Yes. So if the tax code was changed to make it more cash flow, income tax, or anything that is consumption-based, you are saying that the savings rate therefore increase because people will be taxed on their savings, such as capital gains, corporate tax, those things, right?
Saving and investment would be treated less harshly than under current law relative to consumption, and there should be more investment going on and less consumption going on as a share of GDP, but the GDP would be bigger. So consumption would still be higher, but a bigger share of the augmented GDP would be going to saving and investment.
Now, another thing. I know that it's been floated the idea that the capital gains tax should adjust the capital gains for inflation, and I'm not sure whether the Treasury Department can do that unilaterally without Congress. But do you think that that would be beneficial action for making it more consumption-based, even though it's still a mess?
Yes, it's not the ideal solution. You'd really want to have the saving totally deductible and then tax the entire sale, because having deducted the saving, you should tax the whole return, including the whole capital gain. Or you should not double tax the corporate sector and its capital gains on shares relative to the non-corporate sector. So indexing capital gains for inflation goes part of the way toward solving the problem. It is a little cumbersome, and it doesn't solve the whole problem. It's important to note that it's not only on shares of stock that you have a problem with capital gains. Even in a non-corporate business or in a house, if the value of the property reflects the future earnings after tax, if it's the present value of the future after-tax earnings. And if the future after-tax earnings are perceived to be going up because the company invented a new wonder drug, or a better mousetrap, or a better computer program, then if those future profits actually materialize, they're going to be taxed. If you currently tax the increase in the anticipated profit, as well as the profit when it happens, capital gains is double taxation. It's worse in the corporate sector, but it's not only in the corporate sector. All capital gains taxation is a form of double taxation. And you may end up being wrong. They may have losses, and the profit may never materialize, and the stock price goes up, and then it comes down. And whoever sold it on the way up has to pay the tax, and whoever bought it on the way down can't deduct the losses because we limit to $3,000, which has never been indexed for inflation. So it's a heads I win, tails you lose situation. But you really shouldn't be taxing capital gains unless the property was expensed, and then any sale is taxable. Now, in the owner-occupied house, you're not allowed to deduct the house when you buy it. You're not even allowed to depreciate the house. In exchange, we don't tax the imputed rent. We shouldn't also tax the capital gain either. It's all inflation. So the owner-occupied housing was treated much better before we started tinkering with it. It was treated like under a consumption tax with a Roth IRA approach. And all these tinkerings we've done to take away the advantages of owner-occupied housing, they were right in the first place. It's the other businesses we should have begun to treat like owner-occupied housing in a completely neutral way. Other issues, other questions? Thank you for coming. Enjoy the summer.